We are here to share our investment ideology and key learnings from the Masterclass with Superinvestors book, focusing on Ramesh Damani Sir and Vijay Sir. However, please note the following: we are not SEBI registered investment advisors. This video is for educational purposes only. Consult your investment advisor before making any investment decision. The information shared is based on the book and our personal views, but we may be mistaken. Do not take it as a guarantee. Investing carries risk, so conduct your own research and exercise caution. We are not liable for any financial losses. Stay informed and seek professional advice. Let's explore the insights of Ramesh Damani Sir and Vijay Sir. Welcome, fellow investors and bookworms, to our exciting YouTube channel, Finex. I am Pratham, and today we have something truly special in store for you. Joining me are the other three brilliant minds, Aryan, Anuj, and Shreyansh. So, hey everyone, we are thrilled to be here and dive into the fascinating world of investing. Today, we want to talk to you about a book that has profoundly impacted our understanding of the equity markets. The book we'll be discussing is Masterclass with Superinvestors by Vishal Mittal and Saurav Basra Sir, literally gem that provides invaluable insights into the minds of some of the India's most successful investors. We are really glad and thankful to Vishal Mittal and Saurav Basra Sir.
Absolutely, Pratham. Investing can be a daunting task, especially if you are a beginner. This book acts as a guide. It unveils the secrets, the strategies, the experiences, and the wisdom of such super investors who have consistently beaten the markets and made fortune. Whether you are a seasoned investor or just a beginner, Masterclass with super investors acts as a treasure trove of knowledge. It helps us to tap into minds of legends such as Mr. Ramesh Damani, Mr. Vijay Kedia, Mr. Kenneth Andrade, Mr. Ramdev Agarwal, and many more.
And Anuj. That's not all. In this video series, we will be dissecting the key learnings from the book, sharing the most valuable lessons that we have learned, and discussing how we can apply them to our own investment strategies. We will be exploring the topics such as value investing, fundamental analysis, risk management, and the psychology for successful value investing.
Plus Aryan. We will be sharing personal anecdotes, practical tips, and some eye-opening case studies. Our goal is to empower you with the tools and knowledge needed to make informed investment decisions. So if you are ready, let's start.
In today's video, we have the privilege of introducing you all to an esteemed figure of the investing world, and the light shines on Mr. Ramesh Srichand Damani. Mr. Damani is not only an investor, but he is also the chairman of Avenue Supermarts, better known as the DMart. Mr. Ramesh Damani's investment universe goes beyond the Indian stock market. He actively trades in both US as well as Indian stock market. It is very, very impressive to see his investment global perspective at play.
That's right, Anuj. Ramesh Damani Sir's education played a crucial role in shaping his financial acumen. He holds a bachelor's degree from HR College, Mumbai, and an MBA from California State University, Northridge. His educational background equipped him with a strong foundation in finance. Ramesh Damani Sir's interest in stock market was cultivated from a young age. His father, Mr. Srichand Damani, was involved in the equity market back in the 1960s, providing Ramesh Sir with a first-hand exposure to the world of investing.
After completing his MBA, Ramesh Damani sir ventured into the finance industry. He spent several years working in the United States before returning to India. He joined his family business and simultaneously dived into stock market investments, leveraging his experience and knowledge. One of the key factors that distinguishes Ramesh Damani sir in his expertise in value is value investing. He adopts a disciplined approach of identifying stocks that are undervalued in relation to their intrinsic value. This strategy has contributed to his success as an investor.
Sir Ramesh Damani's influence extended beyond his investment activity. He had made a mark in an Indian financial community through his media image. He is often invited as a guest speaker in a financial news channel where he shares his insight and a perspective on the stock market, investment strategies, and the market. Let's not forget the popular stock pick of Sir Ramesh Damani. Some notable examples include CMC, CRISIL, Infosys, Bharat Earth Moving Limited, Bharat Electronic Limited, and Manpower. The choice of his investment shows his ability to identify the great business opportunities in a market. Sir Ramesh Damani's extensive background, education, and experience have made him a respected investor and a financial commentator in the market. His expertise, value investing efforts, and active presence in media has garnered significant influence and following in an Indian investment community.
Thank you for joining us as we explored the remarkable journey of Ramesh Damani Sir. Stay tuned for more insights and discussion as we continue to unveil the wisdom of master investors in our masterclass with Super Investor series.
I'd like to start off and dig a bit deeper into the background of Mr. Ramesh Srichand Damani. So starting off with their early life here, he was born in the 1960s in Mumbai actually, and residence was actually in near proximity of the stock exchange. From his childhood he was surrounded by renowned investors and stock market professionals. Even the stock investing wasn't that popular in the 1960s in India, but still some of the knowledgeable investors on the Dalal Street were known to him, as one of them being his father himself, Mr. Srichand Damani. His father, as I've written here, his father stood out among investors of his era due to his voracious reading habits and in-depth knowledge of international press. So basically, his father was very fond of reading, and he read the financials, the various blogs and information related to multinational companies who were entering India at that time. So these included companies such as Nestle and ABB. So this gave him somewhat of an advantage over his peers who only knew the local conglomerates like Tata Steel and Tata Motors. So he had this extra bit of knowledge over his peers. So moving on, as Mr. Damani got older and older, they were very much known of how much of a knowledgeable investor their father was, but still they didn't have much interest in the stock market as their father, and they went on abroad to pursue MBA in California. Here's an incident which he shares in the book, that in 1982, Mr. Srichand Damani sends a wager to Mr. Ramesh Damani of 10,000 USD. And the only condition was Mr. Ramesh Damani has to invest this 10,000 USD in US stocks, and if he loses all the money, it's fine. He doesn't have to pay it back, and if he generates a return on that money, he can keep all the money, including the returns. So as he was an MBA at that time, he was very confident. And despite his confidence, he lost the entire amount within 6 months during the early stages of the bull market. Let's dive a bit deeper into what exactly happened here. So this is the Dow Jones Industrial Average historical data. So what is Dow Jones Industrial Average? So this is somewhat like a Nifty 50 or Sensex 30. So Dow Jones include the top 30 companies which are listed on Nasdaq or New York Stock Exchange. So basically, this includes the top 30 companies of America. So as we can see, during the period of 1982's, yeah, Nasdaq was around was trading below 1,000, that is around 800 to 900 range, and there was actually a bull market starting from 1982. So during the bull market, he invested all the 10,000 USD that is got from Mr. Srichand Damani, and the bull market actually continued till 2007 and took up the DJIA to the levels of 13,300. So it went from the lows of 7 to 800, 900 to around 13,500. And during this bull market, he lost all of his money. An MBA who did his MBA from California lost all of his money within 6 months of a bull market, not even a bear market, a bull market. And that's what hindered his confidence. Hindered his confidence and gave him a life lesson that market is about looking forward and not backward, and that's why the windshield is much larger than the back view mirror. Let's understand what exactly happened here. So Mr. Ramesh Damani knew that in the 1970s there was actually a high levels of inflation in US, and if you all might know this, that when inflation rises, the prices of commodities such as gold, silver also rises with them. So he had this prior knowledge of gold and silver stocks, that is commodity stocks, doing well in America. But during the 90, so he invested all of its 10,000 USD in commodity stocks. But in 1980s, the inflation was actually the inflation actually got to the previous levels, and as the prices fell down, the commodity stocks also got squashed. And despite of knowing that these stocks have squashed 60 to 70%, he was like, अरे 60 to 70% down है और कितना down जा सकता है. And that's what made him lose all the money. And he learned an important lesson that whenever the bull market ends and the bear market starts, the bull market leaders get squashed completely. So that was the learning that he got during the early stages of his life when he invested in US commodity stocks. So moving on to the economic reforms that were actually happening back in India. So the non-Congress government's policy in the late 1970s. So this was the first non-Congress government in India, led by late Morarji Desai, with George Mendes as the I'll correct myself, with George Fernandez as the industry minister. So what happened was the non-Congress government policy in the late 1970s forced the MNCs to dilute their stake to less than 50% if they wanted to operate in India. So this led to some companies like Coca-Cola getting out of India as they weren't comfortable with diluting the stake to less than 50%. Less than 50%. If the stake of a company is less than 50%, then their ownership and decision making power could be hindered. And that was the thing that made businesses like Coca-Cola uncomfortable, and they left India. But some companies like Nestle, Colgate, and Glaxo decided to dilute their stake to less than 50% and stay in India. And many such companies entered India and got listed on the Indian stock market. So during the as these economic reforms got ready, in the period of 1990s, early 1990s, the investable universe for the investors got expanded due to this policy. And it was Mr. George Fernandez led a groundwork for investors to invest in such companies. And Mr. Ramesh Damani also quotes that due to this unintended consequences of forcing the MNCs diluting the stake and the investable universe increasing for the investors, Mr. George Fernandez was given the title of father of Indian stock market. And many stock market professionals lived in the surroundings. He was used to listen to such influential stocks between their father and other profound investors. Listening to the conversations, he realized that India had unique characteristics that set it apart from other markets. This understanding further piqued his interest in the stock market. So as their interest in the stock market peaked, they actually moved back to India in the year 1988 to 89 and started their own brokerage firm called Ramesh S. Damani, marking the beginning of their personal journey as an active participant of the Dalal Street. So they also shared something during that phase of 1990s, there were actually very huge blocks of blocks of trading. There were actually bulk trading happening, and due to which he was able to milk out lots of profits. Brokerage usually leads to 1 to 1.5% of profits of the total volumes. And he said that even during that time, even this brokerage business felt made him feel secure about his job, gave him a satisfactory result. And as their brokerage business continued to grow, in the upcoming 2 to 3 years, from 1989 to 1993, they actually started to analyze stock and sought to identify different lucrative investment opportunities in India. He also recognized that major changes were onto the horizon for India's capital markets within the next 10 to 15 years. This anticipation fueled their aspiration to transition from being a broker to becoming a successful investor, ready to embrace the transformative development ahead. So what exactly he was thinking about, what exact reforms that Mr. Damani were talking about, we will learn further in our case studies. But that's what we can say, that the anticipation of these changing reforms in India and the projection of growth in the next 10 to 15 years in India is what led to Mr. Damani changing from being just a broker at the Dalal Street to becoming an investor and finding lucrative investments. So now let's move on to some interesting case studies.
after the brief introduction of Mr. Damani, I'd like to move on with some interesting case studies of their from their investing journey. And I guess we'll start off with the most famous holding, which is being talked of, which is Infosys. I'll just give a brief overview of the company, of what actually led to buying Infosys. So basically, Mr. Damani entered the stock market in 1993. At that year only, Infosys got listed in the stock market, which is it issued its IPO, that is initial public offering, in the year 1993. And as Mr. Damani had a technology background, as he worked in a tech company before, he was very enthusiastic about understanding this business. So initially when he started analyzing and studying this business, he was very fond of its management. He found the management to be very promising, with huge aspirations to grow, and a great team running a great company as well. When he moved on to the finances of this company, I'd just like to switch to my Excel sheet here to understand the finances better. Yeah. So these are the financials of Infosys from 1995 to 2002. So actually, we weren't able to get these financials from 1993 itself, but I guess this would be fine to understand what actually led to buying Infosys. So as we can see, the growth of this company is actually exorbitant. Like the sales growing at an average of, we can check, 70 50 70 75 percentage. The PAT margin actually growing over the years. PAT margin is nothing but how much profit after tax you are generating over the your revenue, which is a PAT of 21 crores over the over revenue of around 90 crores. So that's a PAT of 24, PAT margin of 24%. And as we also can see, the market cap has been increasing. We will understand PE a bit later. Then the ROE, which is the return on equity, also increasing. As we can see, there was debt here, but it got paid off after 1997, and this is just the dividend payout of the company. So, talking about the financials, the company is growing at 75% of revenue. The PAT margins are increasing over the years, as well as the ROE is increasing, and there is no debt in the company. So, all the and plus, as we have discussed before, Samani was very fond of its management, and had checked off every corporate governance checkpoint. So being all the boxes checked off, there is left we are left with only one checkpoint to take off, which is the valuation of the company. And valuation of the company is based on two matrices, which is its price and its earning. So to calculate the P, so as we can see, the PE ratio can be calculated by either market cap of the company by its profit after tax. Market cap of the company is calculated by price of one share into number of outstanding shares, and PAT is its profit after tax. Or the second way to calculate PE ratio is price of single share divided by earning per share. Earning per share is PAT of the year divided by number of outstanding shares. So that's the way of calculating PE ratio. And so the lower the PE ratio, the cheaper the company is. So as we can see, we were able to get the price to earning ratio from actually 1996. So that's how we calculate price to earning, which is a market cap of the company divided by PAT of the company. So as we can see, in 1996, the P of the company was 17, which has grew over the years, reaching the heights of 206 in 2000. Now, you may ask, why is a low PE considered as cheap, as a cheap valuation for a company? So let's just understand the simple concept here. So let's say a company is available at a PE, that is price to earning, of 8 rupees. So that which is market cap divided by PAT, or price per share divided by earnings per share. So basically, a P of 8 means 8 rupees of market cap. We are paying the company 8 rupees for every 1 rupee the company earns. So if we decode or try to put some logic into this with numbers, we will compute something known as earnings to price. We will just reverse the ratio here. So we will divide its PAT by its market cap, or its earnings per share by its price of the share. So here the PE will be 8, and the earnings per share will be and the sorry, I'll correct myself, and the EP will be 1 by 8. So if we do the math here, the return which is generated here is 12.5%, which 1 by 8, which is 12.5%. And if we assume that the company doesn't grow over the years, which means by no growth, I mean the company only maintains its growth over the years. It only earns 1 rupee PAT for an infinity, and gives no growth at all. Still, we are earning a return of 12.5% here. And talking of no growth, there is only other metric which gives no growth and steady return, which is fixed deposit, as fixed deposit are not compounded. So if we compare this return to a fixed deposit, which usually pays around 6%, 6 to 7%, 5% at nominal terms, of course. So if we consider 6% of FD, we are actually generating an alpha which is over and above the FD rates. We are actually generating an alpha of 6.5% by investing a company of a lower PE, which is 8 PE, and which has no growth at all. So if we consider the price, if we consider the PE here, which is 17, so even if we do this, by 17, we will be so here the return is 5.9%, 5.9%. But our main assumption here was the company is not growing at all. But in case of Infosys, the company was actually growing at an average of 70 to 75%. So the decision was very lucrative of buying Infosys here. So now the question you may ask is, why was this such a great company, which is growing at an which grew at an average of 75% for almost 5 6 years, is trading at such a low PE? So the answer here was actually, as in India, the investors were very got very comfortable with asset heavy businesses. As Infosys is a service related businesses, it didn't have much physical assets. As I have also written here, investors on Dalal Street struggle to understand technology companies due to their intangible nature and lack of physical assets. And also another point which got added onto this was Sir Damani being among the first investors to invest in Infosys, with the first wave of investors right after the IPO in 1993. So this made Infosys a great stock pick. So as we can see, unfortunately, we got the price chart from 1994 again. So the price, and we weren't able to get it from 1993, as there is limited info available on the on the historical stock prices. You can see here the stock actually went from 0.8 rupees in 1994, in the end of 1994, to 140 rupees, which was its peak during the year 2000. And as we know that it's being said everywhere that Sir Mani actually made a 500x, which is he multiplied his money invested 500 times in the investment of Infosys. But if we calculate here from 0.83 in 1994 to 139 in the year 2000, we get around 168 times his money. So let's do something interesting here. We will try to calculate. So I've already done it here. So I'll just a minute. Yeah, I'll just cut this here from here. Yeah. So we will try to calculate the price which he actually bought in 1993. We won't get, obviously we won't get the exact price at which he bought, but we will try to get an estimate. So as we know that in 1995, which is the end of 1994, so we have considered it 1995. The price of the stock was 0.8 rupees, which went to 139 in the year 2000. So so if we do normal division, we will get 168 times. So the money. So we got to the conclusion that the stock price got multiplied by 168 times from 1995 to the year 2000. Now let's try to calculate it from 1993. So just we'll just do the same here. Yeah, so it's 168 times, which is actually wrong. So we will just use an interesting function. If we go to Excel, the data tab, and if we go to what if analysis and goal seek function, we'll actually get something like this. So what it does is it helps to seek our goal. Our goal here is to, I'll just set this cell. We want value of the cell to be 500, and we know confirmed that the price of the stock into year 2000 was 139. So all we have to change is we have to change the value of the cell, and we'll just hit OK. So it automatically will change its price. So basically, the price at 1993 was actually 0.2 rupees or 0.3 rupees or 0.3 rupees, which went to 139 rupees, which makes a 500 times return. Yeah. So after that discussion of why did Sir Ramesh Damani entered Infosys, we will talk about the exit now. Why did Sir Ramesh Damani sold Infosys in the year 2000? So as we all might know, there was a huge bull market of tech stocks from 1990s to the year 2000, and the year 2000 is where is the year of the dot-com bubble burst. Dot-com bubble burst, I'll just give a brief understanding of it. So basically, the technology was considered to be out of this world or life changing in that period, due to which the tech stocks rallied way too much, and Infosys being one of them. And at the year 2000, the bubble which was created got bursted, and all the investors starting selling of the tech stocks, which led to decrease in the prices. As we all can see from here, from is the chart of Infosys from 1994 to the year 2000. We can see the stock gained momentum, but from the year 2000 to 2010 almost, the stock which fell in 2000, the stock required another 10 years to regain its initial price, its peak price from 2000. That was the impact of the dot-com bubble burst in technology stocks. We can also check out some other stocks to make it more clear. Just a minute. Yeah. So if we take a look at HCL, Hindustan Computers Limited. Yeah. 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 So if we take a look at HCL, we don't have the price before 2000 available. So we will just take a look at this. If we check out this, the peak price in 2000 was almost 173 per share, and after that, it's been an actual downfall for the company. The price was 120, almost no. The price was 170, and to reach its peak price in 2000, the business required 13 more years. That was an example of the dot-com bubble burst. And if we check out companies like Wipro, just check this out. From in 1 year itself, the stock went from 13 rupees to almost the heights of 2 250 rupees, and the crash was unreal. And to reach its peak price, it had to go wait another 19 years. That was the impact of the dot-com bubble burst on tech stocks. So as we know, that Mr. Damani exited Infosys in the year 2000, which was actually a brilliant move considering the dot-com bubble burst happening in 2000, and the tech stocks actually falling apart for the and completely being devastated, and finding it difficult to reach the peak prices from 2000 for the next decade also. As we can see here, let's now as we know the concept of PE, we will be able to understand this in a more deeper way. So as we can see here, from 1996, the PE was 17 to 20, then it went to 49, then it went to 73. The growth was there, undeniably the growth was there, but the valuation which the company was getting was just increasing higher and higher. 73 PE is for every dollar the company earns, we are paying them $73, which reached the height of 206 to 206 6 PE in the year 2000. Also noticed in the year 2000 that the company was trading at a 150 plus forward PE. 150 plus forward PE. To break it down in easier words, we calculate the price to earning ratios on the price. Sorry, I'll just yeah. We calculated a PE ratio with the PAT and the market cap we already knew. So forward PE is actually assuming what the company would earn in the next 12 months, and calculating the PE and likewise. So if we calculated the PE in 1999, the stock was trading at a PE of 73 and a forward PE of 150 plus. So that's how Mr. Damani got to know that, and his analysis also proved it that the company was actually trading at exorbitantly high PE ratio, and he might have not been able to generate more profits, more returns from this stock. So he exited the stock in the year 2000 with a 500x 500x with a 500x return. So now let's take a look at some key learnings and some major takeaways from this brilliant case study. So first of all, recognizing the value proposition. So as we all know, having a tech background, he understood that the work which would have been done if it would have been done in the US, it would cost for example a hundred USD, and the same work would have been done if would have been done in India by major companies by companies like Infosys, it would have been done in mere $10. So he understood the value proposition and invested in Infosys. Next, the corporate governance. As we have already discussed it, their aspirations, their goal, and their hunger to grow. Then again, a key learning would be being the early bird, being the one of the first investors to actually know to actually understand the value proposition behind it, and to invest early, so that you will be getting stocks at a cheaper valuation, which will result into more and more returns for you. Then secondly, we have the long term perspective. We will talk about long term perspective in a bit, where we will talk about price fluctuations. So we will let it hang for a bit and talk about valuations. As we all know, the company, as we can also see here, the company, it's not like the company wasn't growing. The company was actually growing at 73%. The PAT margin was actually 32%. The market cap went 6 times in the year 2000, and still sold Infosys in the year 2000, which is only because of the valuation he was getting. That's how value investors work. We will also talk about value investors in a bit. So that's how value investors are. We as investors cannot make profits, cannot make returns if we hold overvalued assets. So these are the key learnings and major takeaways from this case study. Now, as we discussed earlier, let's talk about the long-term perspective. As we can see here, let's just move on to this slide. We can see from 1994 to 2000, the stock had many fluctuations in it. It's fairly visible. The fluctuations are fairly visible in this. Fluctuation means the stock goes up, and it comes rattling down. Then it starts going up. Then it's come down. Then it starts going up. So when you have such high stakes in such companies, and where the only thing you have here is your conviction, it gets very much tough to counter this price fluctuations. So when asked about in an interview, when Mr. Damani were asked about how did they handle the market corrections when Infosys went more than 100x, he replied, the next Xerox is Xerox. This was actually quoted by an American fund manager when in an interview of his, where basically the American fund manager gave an example of this company known as Xerox Holding Corp, which actually went from the lows of 20 rupees to the highs of 160 170 rupees in a 5-year span. And so again, he emphasizes on understanding the intrinsic value. If the company is still trading at an at or below the intrinsic obviously preferably is below the intrinsic value, that you have calculated, then you should not focus on the short term market fluctuations. You should be firm on your convictions. So the next you point out the difference between fundamentalists and price investors. How fundamentalists, that is value investors do not care even if the stock is double or triple, when they have the conviction that the stock will go for 20x or 30x or 50x. Next is understanding the long term potential. And one more example he gives here is having a network of deep value investors, that is having good investors, good people around you, having nice peers from the same field. So he gives an example of a company called Gillette. So he says that when Gillette shares went from 45 rupees to 500, even after such substantial gains, the share were hold on to, illustrating the value of long-term investment mindset. So some of the peers held the stock, and the stock went from 45 to 500, and still not even 100 shares were sold at that time. And as you can see, from starting from sorry yeah, and as you can see, starting from 2002, the Gillette share has reached the highs of 8,000 rupees. So that's the message from this case study, that short-term market fluctuation, either low or either high, does not matter if you have the conviction that the stock will go 20x or 50x or 100x. You have to be firm on your convictions. Yeah, so we will finish this case study by understanding a small but rather an important topic of the two types of investing: price oriented and fundamental investing, which is also known as value investing. As we can simply read from here, that price oriented investors are also known as technical investor or trader, which mainly focus on price movements, the price movement in the share, and try to capture those smaller fluctuations and generate profits through them. This mainly includes intraday trading. That is they enter the stock and book profits within the market period of 1 day. Uh, yeah. So these are types of price oriented investing methods. So the first is trend trading, which includes buying assets which are increasing price, and selling assets which are declining in price. And also various like momentum trading, where they look for assets with high trading volumes. They take advantage of trading volumes, and they enter the stock as the price as due to high trading volumes, the price increases. So if they know that a stock is being bought in larger volumes, they enter the stock, and at the end of the day they exit the stock with booking minimal profits. But then there's also something called swing trading, where they often hold positions for a few days or weeks, and they use some technical indicators to identify the entry and exit points. They use some patterns such as double tops, head and shoulder formations, or breakouts from key resistance levels. They also use indicators such as relative strength index or moving average conversion divergence, which are actually trading metrics. So just a brief introduction about them. And moving on to fundamental investors. So fundamental investors focus on the intrinsic value of an assets by analyzing its fundamental factors. They consider factors such as financial statements, company management, industry prospects, and economic conditions to derive the value of an investment. So it includes value investing, which is obviously looking at valuation metrics like price to earnings ratio, which we have talked about earlier. So value investing includes buying companies which are trading below their intrinsic values. Then growth investing, which includes buying companies which are high in growth, in growth of earnings, their sales or market share. Market share is nothing but I'll just give a small example. If out of 100 oil sachets, if Hindustan Unilever sells 30 sachets, then the market share of Hindustan Unilever is 30%. So that's what market share is. And moving on to income investing. So unlike price investors, fundamental investors need a regular type of cash flow from their investment, and not focusing on short term profit bookings. So to give an example of, they look at metrics such as EPS, which we have talked before. EPS is nothing but PAT divided by number of outstanding shares. Then debt levels and return on equity metrics. They may also assess the competitive landscape. What is the what type of moat does the company have, which is nothing but a competitive advantage. The team's management, which we have talked about in the case of Infosys, and the overall economic conditions, are they favoring or against the company. So that's the basic difference between price oriented and fundamental investors. So I hope the whole case study of Infosys was very informative and also interesting in some way. So that's it for this case study. We will move on to our next case study now. Okay, so let's get started with our next case study, which is on a company named CRISIL. This is rather a short case study, but it provides valuable insights on how investors fail to time the market while investing. I'll just start off with the introduction here. So investing in stock market can be a challenging endeavor, requiring careful analysis and an understanding of market dynamics. One such challenge is timing the market correctly. I must say that we all might have heard this phrase: timing the market gives more returns. Timing the markets correctly give more returns. So talking about CRISIL. So CRISIL is a credit rating agency from India, which had a which has sorry, I'll correct myself, which has a monopoly in debt trading businesses. So debt trading basically refers to buying and selling of debt instruments such as bonds, government securities, or corporate debt. This created an opportunity for Mr. Ramesh Damani, who believed in potential profitability in this sector. Sir Ramesh Damani wanted to be one of the first entrants to invest in the stocks, as he had a bullish view on this sector, and assumed that this company will be doing great and providing great returns, as he compared them with the companies like S&P and Moody's, which are basically credit rating agencies from the America, which have done great and provided returns in the past. So let's take a look at the share prices too. So I'll just yeah, let's just yeah. So this is S&P Global share price. So if we take a look at the share price, this is the era when Sir started investing. So about 9 USD, 9 USD to around 30 USD. So in almost 5 years, the stock price got tripled. So if you take a look at if we take a look at it from 1993, yeah, so from $7.5 to $70, a 10x return in the next 12 to 13 years or so. It did take some time to generate returns, but yes, these were the two stocks which influenced Damani Sir to invest in CRISIL. But the main catch here was Damani Sir failed to account the necessary infrastructure and market process that were yet to be established in India. So basically, what this line is meant to say, that Indians were not really a big fan of debt trading till then. Like they at that period, there were much more different things, which were in trend, or to say which needed much more focus during that time. So this lack of maturity in debt trading ecosystem and the limited awareness among market participants hindered the potential growth in the initial years, causing Sir Damani to miss out on significant gains. So as we can see, if we check out the share price chart of CRISIL, we can see from 1995 to 2001, the share has almost generated zero returns if we were to invest it for at least for a long term, which is at least 6 to 7 years. And the Vani sir has also quoted that he made a mistake by entering the stock early. He was almost 10 years early in the stock, which can be proven by this price chart. As you can see, the stock price started booming from 2003, and it's been increasing in price since. So that was the main summary of what led to Mr. Damani entering CRISIL early, and how the immature debt trading sector and lack of awareness in the investors led to Sir Damani missing out on significant gains. Yeah, so talking about major learnings and takeaways from this case study, we can say that timing the market is a pivotal role in investment success. But here, Mr. Damani failed to judge the readiness of the market and the industry's ability to deliver returns at that point of time. The industry was promising, the sector was promising, the stock was promising. Yes, CRISIL had a monopoly in the debt trading, but that was not the correct time to invest in that sector. Which is also written here. Even if a business holds promise and possesses monopoly power, it may take time for the market to mature and the investment to yield substantial returns. So the main learnings from this case study to be taken are a need for patience, careful evaluation of market readiness, and the consideration of consumer sentiments to know what's actually going on, to know what might and what may not work in this current market conditions. What is that you find undervalued but may not generate significant results at this period of time, and which you may find overvalued now, but in the near future, like 2 3 years down the line, they might generate exorbitant returns which may justify your overvalued investment. So yeah, this is just the stock price chart for CRISIL. And yeah, so here are the financials of CRISIL. As we can say that the net sales are these are actually 5 yearly financials. The net sales to be growing at 18% 5 yearly CAGR, then to 28% and then 39%. 2010 being one of the best years for CRISIL, and the also market cap increasing as well. And in 2000, the market cap growth has been exponential during this period, 50% CAGR. So yes, this is what we would conclude, that it was a mistake buying CRISIL in the 1990s, 1990 era, where the market were immature and the customer and the investors were unaware of the sector. And it would have been a great investment if Mr. Damani were to take his time, take his time, maintain patience, and consider the market conditions. But let's not be harsh on them, as markets can be irrational for a longer period of time than you can be rational. So basically, this we are at the mercy of the markets. So yeah, I hope you all enjoyed this case study. So let's move on to the next one. So let's begin with our next case study, which is of a company named CMC, which stands for Computer Maintenance Corporation. So just for an overview of this company, what happened was, in the year 1995 to 96, the then finance minister, Dr. Manmohan Singh, decided to de-invest from the PSUs. PSUs are nothing but public sector undertakings, which are state-owned companies, and the finance minister decided to sell them off as he considered them as bhangar or bunk stocks. So one of those companies was CMC. And when George Fernandez, as we have also understood in the introduction, George Fernandez, when he put up the rule of 50% ownership, or the dilution of ownership of MNCs to 50%, most of the MNCs left India, and one of them was IBM. IBM stands for International Business Machine Corporation. And IBM was responsible for handling all the computer related softwares and systems for India. And this role was took up by CMC after IBM left India. So that was the opportunity for Mr. Ramesh Damani. And when he stumbled upon the company's annual report, he actually got to know that the company is available at a market cap of only 30 crores, and where it played crucial roles in projects such as Indian Railways computerization system and the BAC online trading platform. And he knew that if IBM were to carry out this project, they would charge around $150 million $150 million. And for such a such company who has replaced IBM and is participating in such large projects to be available at a market cap of only 30 crores, that's where Mr. Damani knew that this stock is undervalued. So his investing ideology in CMC went true, and the stock turned out to be incredibly profitable, and the stock increased 40-fold, which is from 20 rupees to 800 rupees. As we can see here, we couldn't get the stock price info of CMC, as it got amalgamated with Tata Consultancy Services in the year 2014. So neither the historical nor the present price chart is available for this company. So we are ought to rely on the price chart provided in the book itself. Yeah. Then we will move on to the ideology. Damani Sir attributes his success to his circle of competence, particularly strong background in technology. He also mentions that if CMC, if such things were to happen in some other industry like steel or banking or any other pharma sector, he won't be able to judge the company properly, as he doesn't have as it's not his circle of competence. His understanding of tech stocks led him to buy CMC, and which proved to be a complete success for him. Then Damani Sir recognized the potential of India's liberalization and the leading role that technology would play in driving the country's progress. His better understanding of technology compared to its peers position him at the forefront of investing in the tech sector. Yeah, so we already discussed this part as how his hold over the hold over tech stocks led him to buy the CMC, which proved to be very profitable. But the major learning from this case study was to back up your convictions. If you think that you know something which many other investors do not know, and you have conviction that you have found something undervalued, which is going to be a success, which is going to grow in the next 2 or 3 5 years down the line, then you have to back up the conviction with the right amount of money, how much ever your portfolio approves. So that was the main learning, which Sir Ramesh, Sir Ramesh Damani's father gave to them. That so the risk to reward ratio, as the stock was trading at only 20 rupees, the risk to reward ratio was much favorable. So he advised him to back up his truck, that is to invest as much as money in CMC if he believed in his conviction. Yeah. So here are just the financials of CMC. Then we'll move on to the next slide. Yeah. So these are basically the key learnings and major takeaways from this case study. So first of all, of course, as we have already discussed, investing in undervalued companies. Sir recognized the potential value in CMC despite its lower market capitalization. It's so This ideology involves identifying companies that are trading below their intrinsic value and have potential for significant appreciation, which happened in this case as it generated exorbitant profits. Then circle of competence, as we have already discussed earlier, and also learning a continuous improvement. So highlighted the ongoing process in of learning in investing, and the importance of evaluating market dynamics, understanding economic trends, and staying informed about the company's trajectory. If Sir were not aware of what's happening with the company, of what's happening in India, what are the various reforms, what are the various economic trends, what companies affect due to such economic trends, he won't be able to he wouldn't have been able to invest in CMC. He is a very proud supporter of reading newspaper, reading articles, reading blogs. He always tells to read and read. So that's how you get to know about some market trends, some economic trends which may affect the market, and you might be able to take advantage of those to generate returns. And also, as we talked before, the takeaways would be backing up your convictions, as So's father advised them to invest in the stock at with a more capital, as they had found something extraordinary in CMC. And the next would be overcoming doubts and self doubt. So sir admitted that doubts and self-doubt can still arise even for experienced investors. So it's not an abnormal thing. It's natural human tendency, but it's important to manage your emotions, assess risks and reward, and make investment decisions based on careful analysis rather than uncertainty. So here we can actually connect this to the last case study of CRISIL, where Sir missed to time the market, and here Sir did exactly the same. Sir did perfectly well to time the market. So that's how so that's how investors evolve, right? You get experience, you learn and learn. In the time of CRISIL, they failed to analyze the market maturity, and the market were irrational. The company didn't quite grow due to lack of awareness in the investors. And here we are looking at this example of CMC, and which has been very profitable and a very growing stock for in the journey of Mr. Ramesh Damani. And he also mentioned that this was the stock that this 40 times return that he generated led to the whole investing world knowing who really Ramesh Damani is. Like, yes, Infosys was a much bigger success than CMC, as it generated 500x x money. But finding such stocks where literally no one cares about PSUs, right? So as I have also written here, conviction matters and not the heuristics. So the what are heuristics? Heuristics are basically mind tendencies which are very not not intentional. Like, to give an example, when we are walking down an alley which is quite dark, and we see someone approaching from behind, our pace just starts increasing. It might not be a willingful action, but it's just a heuristic that we just get scared, we get anxious, and our speed gets faster. So that's how a heuristic is about PSUs, public sector undertakings. As they are government owned companies, no one cares about them, as they are bound not to make profits to satisfy the consumers, that is to provide them at cheaper and cheaper values. But as the CMC was but as CMC became private, Sir Ramesh Damani found its value, and and also the its capability to grow, and invested in it, and which proved to be a great success, a 40 bagger for them. Yeah. So these are the two lacunae that Mr. Damani has mentioned about his investing. Lacunae are nothing but gaps or shortcomings, which might lead to you not generating as much as return that you would have generated. So first of all, his initial position should have been much bigger than what he normally had, especially when his portfolio allowed it. So basically, when we take position in a stock, even after having conviction, he might not take those 5% of his portfolio, 7% of his portfolio, 10% of his portfolio. The initial position, he might start off with 2% and 3%, which should have been 5 to 7 and or 10, in order, as he had the conviction and he also had the money, which is his portfolio also allowed it. And secondly, instead of basking in the glory of the stock going up double and going up and doubling multiple times, he didn't back it up with the right amount of money. So here in this whole case study, as well as in the investing journey, this has to be one of the most powerful lessons. These lines, instead of basking up in the glory of the stock going up and doubling multiple times, he didn't back up with the right amount of money. This line can be understood with a method called averaging up. So what's averaging up? So basically, if you can see this Excel, here are some random 15 stocks that I've taken. Here are, okay, sorry, I'll just share my Excel for this. Yeah, I'll just share my I just shared my Excel for this. So basically, this is your portfolio value, which is 1 crore. And okay, these are some random 15 stocks that I have taken. These are actually dummy names and not actual stocks. Yeah, so this is the price. These are the price of them. And okay, so if we decide that in these two stocks, I'll be putting 15% of my portfolio, this to 10, and then 8, 5, 4, la la la, blah 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 blah, and we just put some random numbers here, so that our sum will be 100%. So we have invested, fully invested at portfolio of 1 crore rupees in this 15 stocks. So the investment here would be 15% of 1 crore, which is 15 lakhs. And the quantity bought here would be investment divided by price per share. So this would be the number of shares we have bought of this company. Yeah. So assuming in an year, this stock generates a return of 100%. This 15%, these all, and this too for okay. For 50%, these all 20%, these 10%, these 5%, this 0%, and one of the stock generates a negative 25% return. So current value after an year, the gets over, the current value of the portfolio will be this, the investment into 1 plus the return. So this will be the current value of the portfolio. So our portfolio will become from 1 lakh of, sorry, correct myself, from 1 crore, the portfolio will grow to 1 crore 34 lakhs 85,000. So which would be a CAGR, that is compounded annual growth rate of 35%. So this is example number, yeah. So this is example number 1. This is example number 2, and this is example number 3. So what happens in example number 1? Example number 1, the investor is like Mr. Ramesh Damani. He saw that his stocks are generating exorbitant returns, but didn't do anything about it. He didn't add much capital, much more over and above the capital to his investment. He just let them be as they were. So basically, the percentage increase in portfolio here is only and only because of the returns that they have generated, and not because the investors chose to add on more capital into it. So here, as these 15 lakhs generated a 100% return, so our current value became 30 lakhs. So 30 lakhs being 22% of our overall new portfolio of 1 crore 35 lakhs. So the here portfolio increase in portfolio percentage is only because of returns. And as we can see, the next year too, the stocks generated the same returns, that is 150 and 50%. And after the end of second year, this is our current value of each stock. So here it would be this 30 lakhs plus 1 plus 100%. So it will come to around 60 lakhs, and our whole portfolio will be valued at 1 crore 92 lakh and 88,000. So here, if we were to calculate CAGR of this, if you look at the 1 year CAGR, which is nothing but this year's portfolio value after second year divided by the current value after first year, and not the initial portfolio minus 1. So it comes out at 43% CAGR. And if you were to calculate case at 2-year CAGR, we can use the rate formula here. So I'll just do it again to show you guys. So is equal to, we just type rate, then tab key, and n per. N per is nothing but the number of years. So number of years with this, so number of years will be 1, 2. So 2. PMT will be 0. Present value should always be put with a minus sign. So present value will be this. And after 2 years, our future value would be this. Type 0 and then comma. And we hit enter and we get a CAGR of 39%. So we get a 2-year CAGR of 39%, a 1-year CAGR of 43%. So this is what Ramesh sir did, and he explains how and what he should have done. So here's what and how he should have done, and he mentions in the. So here's what he mentions. So this is what he mentions in the book. This is what he says he should have done instead of this. So let's see what difference does it make. So these are the same stocks still here. This is the same portfolio value. These are the same returns, and this is the current value after first year. So if you can see, this is the current value, and what has changed here is, do we see these 4 stocks? Yeah, generating the lowest amount of returns. We will call them losers. We'll call them losers. So these 4 stocks are losers, and these 3 stocks are winners. So what basically averaging up is, we extract money from losers and put it into our winners to generate higher returns. So how it's done is, if we do the sum of this, it comes around 19 lakhs. Here's what I've done. Yeah. So 19 lakhs. So if we do the sum of these numbers, it will come out around 19 lakhs. So what I'll do here is I'll just I'll distribute this 19 lakh into these three stocks. So it will be 19 lakhs divided by 3. So this would be the amount which comes around 6,33,333. So what I'll do here is I'll just cancel this. I'll just do this is equal to the current value which would have been if we were to not average up plus this value, and I'll just put a dollar sign in between them so it would get fixed, and I'll just stretch. Yeah. So what I have done here is I have cancelled out these 4 stocks from my portfolio after the end of year 1, and I have transferred my investment in these stocks to my winners. And as we can see, this stock is now accounts for 27% of my portfolio. This for 2021, and this for 16%. And if we didn't do our averaging up, it would have been 22, 17, and 11 respectively. So what averaging up did to our CAGR returns, we will just check it out now. So if we calculate 1 year CAGR, it would be 52%. Whereas if we did our 2-year CAGR, it would be Emperor of 2, EMT of 0, present value of a crore, future value of 2 crores, comma 0, comma. So here our CAGR would be 2-year CAGR would go about 44%, and 1-year CAGR to 52%. And if we compare them, you can already see that there's almost a 10% increase in 1-year CAGR and a 5% increase in 2-year CAGR. So that's how averaging up helps in generating higher and higher returns. Now let's move on to the third type of investor, which is also very interesting. There are obviously there are lots and lots of type of investor with different mindsets. So I thought why not introduce you all to the third type of investor too. So this investor did nothing. He just went with the flow. He let his stock perform as they were performing. Whereas this investor took money from the losers, invested it in the winners, and generated profits, which were, of course, more than the investor who just went with the flow. Now let's move on to the third type of investor who did exactly the opposite of averaging up. What he did was his mindset was, I have generated 100% return in this portfolio. So why not I book my profits, not book my profits. I'll maintain my portfolio position, that is sorry, portfolio stake in the stock the same as they have grown from 15, as we can see, as they have grown from 15, so from 15% to 22% of my portfolio, the investment went from 15 lakhs to 30 lakhs. I'll just maintain my investment to 15 lakhs, which is 15% of my initial portfolio. So what I'll do here is I'll just maintain my position even if even if I generate higher returns on them. How I'll do it? So I'll just put I've just returned these profit from these three stocks. Yeah, these three stocks. So if it were to give 100% result, so it would give, so yeah, so we'll just do it into 100. So it would give 100% return, and then if this stock were to give 50% return, it will give 7,50,000, and this stock to give 50%, it will give a return of 5 lakh. So if we if we add this up all up, so it will come out around 27 lakh and 50,000. So what I'll do here is I'll just divide this profits that we have generated from a top performing stocks to our lower performing stock, in hope that they would generate exorbitant returns in the near future. So what we will do here is we will divide this 27 lakh 50,000 by 4, and we will invest this in the losers. So so what we'll do here is this plus this amount. I'll just fix this amount with dollar signs. Yeah, and I'll just stretch this. Yeah. So that's what we will do. Now let's look at our returns. So the 1 year CAGR here would be 26%, which is the lowest among all three. And the 2-year CAGR, let's calculate it by rate formula. Now we know N per is 2, PMT 0, present value is minus crore, future value would be 1.71 crores, type 0. The 2-year CAGR here would be the lowest, which is 31%. Now, if we were to compare all of these three, and just put these three in a line, and just put the percentage mark. So this would be the go with the flow investor. This would be the average up investor, and this would be the profit transferring investor. Here, yeah. So we have results in front of us. We'll just give conditional formatting to it, so it would be better to understand this. Yeah. So we have the results in front of us. We have studied three type of investors here: go with the flow, average up, and profit transferring from winners to losers. So I hope the averaging up concept was very clear, and I hope that it was informative and educational, as well as from a book, from an understanding point of view of the book, as well as from a real life investing point of view. And I hope you all apply this method to your investments, to your portfolios, and generate high returns. So that was it for this case study. Now Pratham will take over and explain the remaining case studies.
Thank you for joining us in part 1 of our masterclass series, where we explored the background of Ramesh Damani Sir and discussed a few captivating case studies. We hope you found it insightful and informative. In the upcoming part 2, I will take over and deliver deeper into the additional case studies, unraveling the investment ideologies and sharing key learnings. Get ready for an exciting continuation of our exploration into Ramesh Damani Sir's investment wisdom. We appreciate your support and engagement throughout the series. Stay tuned for more valuable insights and join us in the part 2 for an enriching learning experience. Thank you and see you soon.